Welcome to The Spot on Urban Real Estate. I'm Ian Watt. Today we're sitting down with James Owen, a professional accountant, to talk about the implications of real estate tax.
Assignments are where an individual has purchased a piece of property prior to the property being actually developed or actually constructed. The assignment is the buyer is actually saying, I'm buying this piece of property with the intent that I will occupy or have it as an investment property at a later point. Assignment properties as such are very, shall we say, good investments. However, there are certain stipulations that must be adhered to at the point of sales. Assignments as such, when they're sold, can be a little bit complicated because many people, what they wish to do is flip these properties at a later point. And flipping, of course, means selling that assignment and making a profit. And of course, under those circumstances, capital gains becomes an issue. And of course, also, GST becomes an issue. On a personal piece of property, there's no capital gains. It's a principal residence. You can make a lot of profit and not have to be concerned about capital gains. However, when you have another property over and above the principal or matrimonial property, then that is understood to be an investment property or a revenue property. So under those circumstances, when you sell those properties, capital gains comes in, and the capital gains is basically 50% of the net. In other words, if we use an example, you bought a property for hypothetical reasons, you use simple numbers, $100,000, and you sold it for $200,000. In theory, the capital gains is $100,000, less, some closing fees or whatever things you might have to have spent money on to, painting and all this other good stuff in order to sell it. That comes off the top. But if we take the hypothetical case that it's $100,000, the amount of capital gains is 50% of the $100,000. Then on that remaining $50,000, you're taxed at whatever, if it's a personal person, that $50,000 would be applied to his personal income or whatever's coming in, and whatever tax level that individual is taxed at, that half of the capital gains is taxed at that amount. Now, however, if we now enter into another area, if you're doing this more or less on a professional level, which some people are, they have an incorporation. And the incorporation, of course, must have the title of that revenue property or investment property as part of the package in the corporation. The same thing applies, 50%. In our example, we used $100,000, so 50% of $100,000 is $50,000. That would be taxable. However, in the corporation, you're only taxed at approximately around 21%. So the advantage of having a corporation is, of course, a real advantage in terms of taxes.
That's all the time we have for today on The Spot on Urban Real Estate. To contact James Owen, please visit our website at ianwatt.ca. Thank you very much.